While equity fund holders were left with a lot to complain about from Budget 2024, there were a couple of pieces of good news for debt fund holders. What was that, and what should your strategy be? I have with me Deepak Agrawal, the Chief Investment Officer for Debt with Kotak Mahindra Asset Management Company Limited. Hi Deepak, and let's start off first with the budget announcements. There was a slight reduction in the fiscal deficit target for this fiscal year. What is your take on that? How would that essentially affect the government's borrowing calendar and consequently the demand and supply of bonds in the market?
Hi, see, the government in the interim budget had pegged the fiscal deficit for FY25 at 5.1%. Now, post the interim budget, Government of India got close to 1,25,000 crore extra dividend from RBI, which they could use entire amount to reduce, let's say, FY25 fiscal deficit. However, post the election outcome, a market was expecting that the entire amount, government will increase the expenditure by a similar amount. So fixed income market participants were keenly watching the budget. However, government has given a pleasant surprise where they got an extra revenue of 1,25,000 crore. They decided to increase the expenditure only by 50,000 crore, and 75,000 crore has been utilized to reduce the fiscal deficit, which is a positive news for fixed income market. So now the fiscal deficit target for FY25 is pegged at 4.9% of GDP. The 75,000 crore fiscal deficit which they have reduced will lead to approximately 12,000 crore less supply in dated securities, and the short-term borrowing of Government of India is also reduced by 50,000 crore. So it was a positive budget for fixed income market. If you look at the budget maths is also very credible. The nominal GDP growth rate is pegged at 10.5%, and the tax revenue growth is pegged at 11.5%. According to us, these numbers are conservative. And let's say higher tax revenues over the course of this year can lead to further reduction in borrowing during the current year. Or it may result in government carrying higher cash balances next year, which will lead to less fiscal deficit in next financial year. Plus, let's say government has also guided for a lower fiscal deficit for next year, where they are saying that the fiscal deficit for FY26 is likely to be sub 4.5%. We believe that the combined fiscal deficit of center plus state put together is likely to be around 7% or lower in FY26, which is one of the preconditions laid down by S&P, and therefore we assign a high probability of a rating upgrade over next 18 months. The domestic demand supply situation was anyways favorable because increasing demand for GSEC domestically and reducing fiscal deficit. In addition to that, this year we have index flows. Index flows have started, but a bulk of flows are yet to come. Plus, RBI has proposed some changes to the LCR guidelines of banks, which will also lead to approximately 2.5 to 3 lakh incremental demand for GSEC. So all these factors put together, along with our view of rate cut over the course of next 1 year, we think that 10-year GSEC, which is currently trading at around 690-95, can come down by 40-45 basis points. And 10-year GSEC can come down to 6.5% over next 6 to 9 months.
We have another important event coming up, and that is the RBI Monetary Policy. What are your expectations from this time around?
So post the June policy, we were watching for 3 events to decide whether RBI will change the stance in the August policy. So one was budget. So the budget outcome has been favorable. Fiscal deficit has been pegged lower at 4.9%. And plus budget, according to us, has given a non-inflationary impetus to growth. So which should give comfort to Reserve Bank of India. Second event which we were watching out was monsoon. Even though monsoon was weak in June, it has picked up in July, and we believe that we'll have a normal monsoon, which will also help in keeping food inflation in check. And third factor which we were watching was what's happening in US or US likely actions from the US Fed. Even though in June Fed guided only for 25 basis point rate cut during calendar year 2024, post that muted growth along with falling inflation has led to again increase in market expectation with respect to cumulative rate cuts. Now market is pricing in close to 75 basis point rate cut in calendar year 2024, and a September rate cut is fully priced in. So plus if we see, Bank of Canada had cut rates prior to the June policy. They have cut rates last week. So cumulatively here we have a central bank cutting rates by 50 basis points even without Fed cutting any rates. So all the above three factors mentioned, we believe that there is merit for RBI changing the stance to neutral in the policy next week.
What's your assessment of the liquidity situation currently?
So liquidity, which was tight in the month of April and May, largely on account of increase in currency in circulation, it has eased in the system. So the total liquidity in the system is close to 1.5 lakh crore. And it has increased because government has also resumed its spending. Plus, Government of India had cut its T-bill borrowing program. So all these factors have led to increase in liquidity in the system. And even though RBI is trying to suck out that liquidity by conducting VRRR auctions, but what we have seen is the overnight rates have stabilized closer to repo rate in the band of 640 to 650. What has this led to? The extreme short-term rates have further eased by 10 to 15 basis points over the course of last 2 months.
And finally, to summarize our conversation, what would you recommend as a strategy for debt mutual fund holders?
So this budget has reinforced the fact that India's strong macroeconomic story continues with government reducing the fiscal deficit, lower inflation, lower CAD, and our view that interest rates have peaked both domestically and globally. We have been asking investors to increase duration for last 6 to 9 months, and the view continues to remain the same. And therefore, investors should look to increase duration. By increasing duration, you reduce the reinvestment risk on the portfolio. At the current juncture, we believe investors can consider investing in corporate bond funds, medium-term funds, a dynamic fund, or the longer duration funds.
All right, Deepak, thank you so much for that.
Thank you.
Well, that was, of course, the advice coming in and the outlook for the debt market for this month. Stay tuned to Kotak Mutual Fund as we'll be back with more such insights.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.